Everyone, thank you for joining us in our monthly trade outlook. Before we get into our current outlook, we'll do a quick recap here of April's numbers. For the month of April, IG was up 10%, which was nicely in line with the North American equity markets. In terms of performance thus far in May, we're up another 1.5%. So continuing to build on some good momentum from last month. And in terms of what we're expecting here going forward, I'll bring in Mark for our collective outlook. Mark.
Thanks, Shawn. Yeah, stocks have definitely rebounded much harder than most of us expected from March lows. That being said, we do believe risk-on indicators are beginning to validate our rally. Risk tolerance overall has definitely improved since credit risk has potentially been immunized by the actions of central banks and governments. And since equity and credit are joined at the hip, stocks could be rising on the perception that an unforeseen credit event that could derail equities is unlikely in the near term. It's also important for us to point out that short positions are still at record highs, so that's definitely an argument for further upside. In terms of valuation, it's definitely becoming a bit more challenging to justify recently. But as we continue to point out to a lot of our clients, all of our clients who we're speaking to, it's very skewed to the growth segment of the market, i.e. the FANG stocks. We believe that until value stocks get more expensive, investors will not become truly concerned about market valuations. And certainly there's many stocks out there that are still significantly below their highs. On that note, value stocks do appear cheaper than they are, though, because of the continuing cycle of downward earnings revisions, which is not yet complete. So for the time being, we are remaining neutral on equities. As we said in our last call, we are very focused on a stock-by-stock approach at this point, as opposed to a market-based approach. It would not surprise us to see this market become choppier over the next few months, and therefore this stock-by-stock approach will be especially valuable to our portfolios. With that, I'm going to pass it on to Erik to talk a little bit about the overall global economy. Erik.
Yeah, I think, thanks, Mark. And I think that you can't really look at the global economy without taking a look at what the major central banks are doing around the world. And I think in the press, for our viewers and readers, a big part of this central bank movement is the question is whether it's enough. You know, this is, as they say, an unprecedented time, and by definition, that means we've never seen this before. It's never been known before. We've got four major things pulling things in different directions. So you've got the pandemic, you've got the global contraction, you've got a huge oil price collapse, and then you've got the federal governments and the government response with loans, grants, stimulus, and bond buying. And the question is whether it's going to be enough. And we actually, our macro guys have done a lot of work, and they believe that it is currently enough. And furthermore, that the Fed in the U.S. has said that if it's not enough, they'll add. So with that, I would say that, you know, whether it's the U.S. or Europe or China, they're targeting trillions of dollars of you know, spending, and a lot of that spending is going to go through into the infrastructure side, which is good, because I think that's where the multiplier will be optimal. And I think, Shawn, you'd written that in our piece this month. So, you know, with that, I would open it to maybe any questions that might be out there. Shawn?
Yeah, we got a couple questions here, guys. Mark, I'll start this off with you. It's about the VIX, the volatility index. We've seen a big pullback since the March level. It got to 80. As of this morning, it's at 27. How does the lower VIX validate this market recovery that we've seen since March?
Well, for those, I guess, first, maybe we should probably define what the VIX is for those of our listeners who maybe don't know exactly what it means. The volatility index, or VIX, is a real-time market index that represents the market's expectation of forward-looking volatility. So how much we expect the market to move up and down. It's derived from price inputs on the S&P 500 and provides that measure of market risk and investor sentiment. So, for example, in the March lows, we were pushing a high of, I think it was in the high 80s. Did we hit 90, Shawn? Do you recall?
I don't think we got to 90, but it was in the 80s.
Yeah, it was in the 80s. And for that reason, it's also known as a fear gauge. Investors often look to the VIX as a value. VIX values as a way to measure market risk and the fear and stress in the market before they make those investment decisions. As Shawn just mentioned, it just recently dipped below 30. And from a technical perspective, because this is a technical tool, not a fundamental tool, from a technical perspective, that's confirmation that an intermediate term peak has been put in place on that VIX, and it's dropped down below that, and it's probably not going to necessarily need to go through that in the near term, which also means that we've probably seen an intermediate term low in equity markets. So we've set some sort of base level for the time being. So for now, the VIX, or fear gauge, is showing us that fear has been reduced and investors are likely not running for the exits at this point.
Yeah, I'm just looking at it here. The high was 85.47, so it didn't get to 90, but definitely elevated from where it was today.
I don't know what the what was the maximum in 2008 and 2009? Do you recall?
I think it was around this level, but it didn't. The speed in which we saw the correction this go around was a lot faster, which would impact the VIX a lot more. So it was definitely extremely historically elevated. Another question here on gold, which is obviously continues to be very topical. Gold companies are realizing their highest average Q1 price. So we're about to see the margins here for the miners likely explode to the upside, which is phenomenal. Erik, this one is for you. Is there more room to run in bullion, and what does this mean for the companies in the sector?
Yeah, thanks, Shawn. Definitely bullish on gold. Gold today trading at about $1,706 an ounce. There's a lot of reasons to own gold. First and foremost, when you've got this market uncertainty that we've had, it's a great way to put your money aside and know that it's going to hold its value. Paper currencies don't typically have the same tangible effect as gold does. We've got M1 increasing, or money supply increasing around the world, which is also a bullish case for gold. And since January, we've seen a remarkable run in the US dollar, which is now looks like it's turned with most global currencies here, and a weaker US dollar is also positive for gold. So for those reasons, I think the average target out there, Shawn, correct me if I'm wrong, is around $2,000 an ounce.
Yeah, that would be around consensus. There's bull targets as high as 3,000 an ounce, but I don't think that's an expectation that we're going to see anytime soon. So
maybe, Shawn, you can comment on the gold holdings that we've had in the portfolio.
Yeah, Wheaton Precious Metal, which is a bit of a streamer. It's not an exploration company. It's been a core holding of ours, I think, for about a year and a half. It hits an all-time high, I believe, last Friday, up to 61. We initially started buying that one when it was in the low 20s, so it's done extremely well. We did, in fact, trim it in April just as a function of its price appreciation being too high. Became a bit of an overweight in the portfolio, but we still love the name. We still continue to hold it. It's one of the best performing names this month in our portfolio. It's up an additional 15%. So it continues to execute very well, and we think there's more room to run on that name for sure. Next question here is on oil. Mark, I'll throw this one your way. Oil's had a tremendous bounce from -37 to today. It's 26 and change. So nice little rally there. Is it safe to assume the worst is behind us for the price of oil? And what about companies in the sector? Obviously, a lot of us out here have exposure to a lot of Canadian energy names.
From a Canadian perspective, I hope we are awfully close to it. You know, it's hard to know exactly. I mean, to put it in perspective, year-to-date Brent, I believe, is still down over 50%, and WTI is down more than that on the year-to-date. WCS, which is the oil that we primarily look at on the Canadian side, which is Western Canadian Select, is down slightly less than that, at around 35% or so, somewhere in that range. Also with the rig count, North American rig count is down over 50%, and OPEC has done so many production cuts and company shut-ins throughout the world. We feel the market should be balancing out by the second half of this year. So that's hopefully good news for oil and gas companies. On a technical basis, throw this in there too, US gasoline consumption has cratered, obviously. We're starting to see a bit of a pickup in that now, with people starting to begin driving again. And inventories almost hit capacity at Cushing, which is obviously why we went into the negative for a little bit. And for those of you who don't know, Cushing is the delivery point for crude contracts and the price settlement point for WTI. So basically WTI flows from all points in the US into Cushing and then moves outbound through the pipeline. So as we all saw in March, at one point, we saw an oversupply there that they couldn't get rid of it. So they had to actually pay for getting rid of their gas, which was not a great scenario. So we, despite all of these factors, which all sound incredibly negative, US exploration and production company stocks have begun moving higher. So that seems to be a bit of a turning point in the oil and gas sector. We saw the same thing happen in 2008 and 2009, and that seems to indicate that we have hit probably bottom. That being said, we're not anxious to go and jump in and get overweight in the sector. But I would suggest that for any longer term investors, that being a minimum 12 months, probably 18 plus, there's some good opportunities out there, and it's a good time to begin picking away. So hopefully positive news for Canada.
Yeah, I would just add that we're seeing oil trade up here today. This is after Saudi Arabia, UAE, and Kuwait have all voluntarily cut another 1 million barrels per day in June's production. This is obviously in addition to the May numbers that we saw where they cut 9.7. So still a lot of cuts occurring. So it should only help boost crude prices. Last question, Erik, this one's for you. No coincidence that the USD is US dollar is down since our last call, and the markets have just continued to rally. What are your thoughts on the currency exchange there?
Yeah. I think that, and we think that the US dollar will continue some weakness. The rise up in the US dollar probably to its peak was because it was a huge risk-off market. And, as Mark mentioned, with respect to the VIX, buyers are starting to come back into this market, and that's been dropping the US dollar. Now, vis-a-vis the Canadian currency, that's a tough one. And we've got oil, given that they're our largest trading partner. Certainly the US would like to see a cheaper US dollar here for their exports. So we are bearish the US dollar going forward.
Yeah, I would 100% agree with that. And that'll do it for the questions. Nothing else there. So unless Mark or Erik, you guys had some closing remarks, I guess that's it for the call.
I read a good quote from Voltaire, which is 250 years old, and I think it was quite relevant to the current markets. And he said that doubt is unpleasant, but certainty is absurd. So I guess that's what creates the markets out there. But yeah, I think that comment from 250 years ago stands today. So with that, I'll say stay safe, and to all our viewers and readers, we thank you.